Ever wondered what sets apart those companies that just skyrocket in value? You know, the ones like Home Depot, Microsoft, Cisco Systems, even Google.
Yeah.
Well, today, we're unlocking those secrets,
Nice.
diving deep into how to make money in stocks. It's a classic. This book, by the way, is published by McGraw-Hill, and it's written by William J. O'Neill, founder of Investors Business Daily.
Oh, wow. IBD. Okay,
Yeah.
cool.
So get ready for proven strategies and real-life examples.
I love that combo.
I know, right? All designed to help you pick those market-beating stocks.
Awesome.
The core concept here is the CAN-SLIM formula. Each letter, and we're going to get into this, represents a key characteristic of those winning stocks.
I'm excited. Let's unpack it.
I am too.
Yeah.
What I think is so cool about this book is he actually analyzed over a century of stock market winners
Wow.
to figure out what they all had in common,
A century.
going all the way back to the 1880s.
Okay.
So how do we find these hidden gems? Well, the book's secret weapon is the CAN-SLIM formula. Each letter stands for a key characteristic of a winning stock. Think of it as your checklist for success.
I like checklists. I like success. I'm in.
Perfect. It's not just a checklist, though.
Oh.
It's a roadmap.
Okay.
Each element helps us understand the underlying story of a company, its growth potential, its position in the market,
I see.
and how it interacts with the overall market trend.
Got it.
Okay, let's break it down.
Yes.
C stands for current earnings.
Current earnings.
We're not talking about small incremental gains here.
Yeah.
O'Neill wants to see serious growth,
Like what?
like earnings per share up 25 to 50% at a minimum compared to the same quarter last year.
Okay.
He's looking for companies that are firing on all cylinders, you know,
Uh-huh.
the ones that are blowing away expectations. Remember like Dell, Cisco, AOL back in the 90s?
Oh, yeah. Totally.
Their earnings were exploding, and that's what fueled those massive stock price gains.
I get it.
So the first takeaway is, don't settle for mediocre earnings growth. Look for companies that are truly exceptional, the ones that are outperforming their peers by a significant margin.
Right.
Now, what about A?
Annual
Earnings.
earnings. Okay.
It's not just about having one good quarter.
Right.
It's about consistency. We want to see that track record.
Uh-huh.
Strong earnings growth year after year.
Makes sense.
This is where a lot of people get tripped up. You know, they focus too much on that price to earnings ratio,
The PE ratio.
the PE ratio.
Yeah.
O'Neill shows that sometimes a high PE ratio
Oh.
isn't a bad thing.
Wait. Most people think a high PE means a stock is overpriced.
Exactly.
Mm-hmm.
But if a company's earnings are growing like crazy,
Right.
that high PE ratio
Okay.
can actually be a sign of future potential.
Mm.
Look at companies like Syntex, Gentech, and America Online. They had high PE ratios,
Yeah.
but their earnings were skyrocketing,
Yeah.
and their stock prices followed suit.
So instead of just looking at the price tag,
Yes.
we need to see if the earnings justify that valuation. It's about understanding the growth story, not just the current price. Okay, got it. What's next?
So that brings us to N newness.
And newness. Okay. So is it all about shiny, brand new companies?
Well, it's not just about the age of the company. It's about new products, new management,
Okay.
new highs in the stock price.
Yeah.
Anything that shows a company is innovating and disrupting the status quo.
I see. So like a company that's been around for a while
Yeah.
can still exhibit newness if they're launching a game-changing product or shaking things up.
Yeah, like a new CEO or something like that.
Right, exactly. Think about Home Depot. They totally revolutionized the home improvement industry,
Mm-hmm.
left their competitors in the dust.
They weren't brand new,
Right.
but they had that newness factor in spades.
Okay, so newness is about recognizing that potential for explosive growth regardless of the company's age.
Exactly. Now let's move on to S, supply and demand.
S, supply and demand. Oh, man, flashbacks to econ class.
Yeah.
How does that apply to stocks?
It's the same principle. When supply is low and demand is high,
Right.
prices go up.
Okay.
This is especially important for like smaller companies.
How so?
They have a smaller number of shares available.
Okay.
So if there's a surge in demand, their prices can rise much faster than larger, more established companies.
Oh, so smaller companies can be more volatile,
Yes,
but they also have the potential for quicker gains.
exactly. On the flip side, the book warns us about companies that split their stock too many times.
Mm-hmm.
This increases the supply of shares,
Right.
and that can actually dampen price growth.
Interesting.
It's a reminder to look beyond the headlines,
Okay.
Understand the dynamics of the company's stock float. Is the float small, tightly held? Is there a lot of buying interest? It's about understanding the forces at play behind those price movements. Now let's move on to L leader or laggard.
L leader or laggard. Okay, break that down for me.
This is about identifying the companies that are at the forefront of their industries, the ones that are setting the pace and leaving the competition behind.
Ah, I gotcha.
Think of it like this. Would you rather invest in the company that's creating the future
Okay.
or the one that's struggling to keep up?
Definitely the innovator, the one that's shaping the industry.
Exactly.
Not just reacting to it.
Exactly. And O'Neill uses this great analogy. It's from Andrew Carnegie, the steel magnate.
Oh, yeah.
He said, the first man gets the oyster, the second man gets the shell.
Ooh, I like that.
It's all about being in the right place at the right time.
Right.
And that means investing in the leaders, not the laggards.
Makes sense.
So we're looking for those companies that are dominating their markets, the ones that are capturing market share and driving innovation.
And how do we identify these market leaders?
Well, one tool O'Neill introduces is the relative strength rating, or RS rating.
RS rating, okay.
It measures how a stock is performing compared to all other stocks in the market.
Got it.
The best performing stocks, before their major run-ups,
Yeah.
had an average RS rating of 87.
80.
That means they were already outperforming almost 9 out of 10 other stocks.
Wow, that's incredible. So a high RS rating is like a seal of approval,
Yeah.
a sign that a stock is already on the move. This makes me wonder, what are some examples of companies with high RS ratings
Yeah.
that went on to perform exceptionally well? There are tons of examples, actually, but one that comes to mind is Apple. Back in the early 2000s, before the iPod and the iPhone really took off,
Yeah.
Apple's stock had a sky-high RS rating.
Okay.
It was a sign that something big was brewing, even though most people weren't paying attention yet.
So the RS rating can help us spot those under-the-radar companies that are poised for breakout growth.
Yep.
It's like getting a sneak peek at the future stars of the market.
Exactly.
Okay, on to institutional sponsorship.
Institutional sponsorship.
This sounds a little intimidating.
Yeah.
What does it mean?
It simply means that big institutional investors, like mutual funds, pension funds, hedge funds,
Okay.
they're buying into the stock. And these guys aren't just throwing darts at a board. They have teams of analysts who do their homework, digging deep into a company's financials and prospects.
So it's like having some of the smartest money in the world indirectly backing your investments.
It is.
That's reassuring.
It is. And there's another benefit.
Okay.
Liquidity. When institutional investors own a significant portion of a stock,
Right.
it means there's a lot of buying and selling activity,
Right.
making it easier for you to get in and out of your position.
That makes sense.
Yeah.
I wouldn't want to get stuck holding a stock that's hard to sell.
Right.
So we've covered the first 6 letters of CAN SLIM: current earnings, annual earnings, newness, supply and demand, leader or laggard, and institutional sponsorship.
We have.
That's a lot to consider.
It is.
What's the final element?
The final element is M, market direction.
Market direction.
And this is where it gets really interesting,
Okay.
because even the best stocks can struggle if the overall market is heading south.
Right, it's like trying to swim upstream. No matter how strong you are, it's going to be tough going against the current.
Exactly. And O'Neill emphasizes that understanding market direction is crucial for success. He talks about using tools like the Dow Jones Industrial Average, the S&P 500,
Okay.
the NASDAQ to assess the overall health of the market.
So it's not enough to just pick great companies.
Nope.
We also need to know when to buy and sell based on those broader market trends.
You got it.
That sounds like a whole other level of expertise.
It is, but it's not as daunting as it sounds. O'Neill breaks it down into simple, easy-to-understand concepts.
Okay.
He talks about recognizing patterns in price movements, volume,
Right.
and those telltale signs of distribution that can signal a market top.
So we need to become like market detectives, learning to read the clues and anticipate those shifts in momentum. That sounds fascinating.
It is.
But I have to admit, I'm still a bit intimidated by charts.
Well,
All those lines and squiggles seem like a foreign language.
don't worry, you're not alone. A lot of people feel that way about charts, but O'Neill does a great job of demystifying them.
Yeah.
He explains that charts are simply a visual representation of the supply and demand forces we talked about earlier.
So those squiggly lines are actually telling us a story.
They are.
We just need to know how to read them.
Exactly. And the book breaks down all sorts of different chart patterns, like cup with handles, double bottoms, and flags.
Okay.
These patterns can help us identify when a stock is building up momentum and getting ready for a big move.
That's amazing. It's like learning to read the footprints in the snow those subtle signs that tell us where the big game is heading.
I like it.
So by studying charts, we can actually anticipate those big moves and get in early.
Precisely. And O'Neill also stresses the importance of paying attention to volume.
Volume.
Is volume increasing on those up days? That's a sign of strong demand.
Okay.
If volume is drying up, it could be a signal that the momentum is fading. It's all about paying attention to those subtle clues that the market is giving us.
So we've got our CanSlim checklist for picking winning stocks.
We do.
And we're learning to read the language of charts to time our entries and exits.
Right.
What else do we need to know to become successful investors?
One of the most important and often overlooked aspects of investing is risk management.
Risk management.
Even the best investors make mistakes.
Oh, yeah.
So it's crucial to know how to handle those inevitable losses.
So what's the secret to managing risk? Is it about diversifying our portfolio, spreading our bets across different sectors and asset classes?
Actually, O'Neill takes a different approach. He's not a big fan of over-diversification.
Really?
He believes it's better to focus on a handful of high-quality stocks that you understand deeply.
Interesting. So it's about quality over quantity.
Yes.
Focusing on those companies that truly have the potential to deliver exceptional returns.
Exactly. He compares it to building a winning baseball team.
Okay.
You don't want a roster full of mediocre players.
Okay.
You want the best of the best.
I like that analogy.
And he has a very specific rule for limiting losses.
Okay.
Cut your losses quickly.
Wait, what? Don't most financial gurus tell you to hold on for the long haul, to ride out the volatility?
O'Neill disagrees.
Okay.
He says small losses are cheap insurance. The book advises selling any stock that drops 8% below your purchase price. No exceptions.
Wow, no exceptions.
No matter how much you love the company.
Okay.
No matter what the experts are saying, if that stock drops 8%, you get out. No questions asked.
That's a bold strategy, but I can see the logic.
Right.
It's about protecting your capital and preventing small losses from turning into big ones.
Precisely.
Yeah.
And it also helps you stay emotionally detached from your investments.
Yeah.
If you're constantly worried about a stock that's tanking,
Right.
it can cloud your judgment and prevent you from making rational decisions.
Okay, so we're cutting our losses quickly, but what about those winning trades? When do we take profits?
That's a great question, and one we'll explore further in our next segment. But for now, let's leave you with this thought. O'Neill says, the secret to making big money in the stock market is not to be right all the time. It's to be right and sit tight.
So we've nailed down our buy signals. We know how to protect ourselves on the downside.
Right.
But how do we know when to cash in on those winning trades? Is there a magic formula for that too?
Well, there's no magic formula, but O'Neill provides some excellent guidelines.
Okay.
It's all about recognizing those subtle shifts in momentum that can signal a stock is topping out.
Right.
For instance, he talks about what's called a climax top.
A climax top.
This is where a stock has a huge price surge on massive volume.
Right.
It can feel exhilarating, right?
Oh, yeah.
But it's often a sign that the buying frenzy is ending and a short-term top is near.
It's like that moment at a party when things get a little too wild and, it's probably time to hit for the exit before it gets out of control.
Exactly. Another sign to watch for is an exhaustion gap.
An exhaustion gap.
This happens when a stock gaps up in price on heavy volume, but then fails to hold those gains.
Okay.
It often means the buyers are running out of steam and the sellers are taking over.
So it's like a warning sign.
A
A gap in the chart that doesn't get filled,
Right.
indicating that the momentum might be shifting. And of course, we're always keeping an eye on those support levels.
Yes.
Those price points where a stock has historically found buying support.
Absolutely. If a stock breaks below a key support level on heavy volume, it could be a sign that the trend is reversing and it's time to get out.
Okay, time to get out.
Now, remember O'Neill's rule about cutting losses at 8%?
Yeah.
Well, he also suggests taking at least some profits
Okay.
when a stock is up 20% to 25% from your purchase price.
Okay, so locking in some gains along the way is a smart move, especially if the market starts getting choppy.
Exactly.
What about those longer-term holds? How do we know when to let go of a winner that we've been riding for a while?
O'Neill advises selling if a stock breaks below its 10-week moving average line on heavy volume.
The 10-week moving average.
Think of it as like a trailing stop-loss order.
Okay.
A way to protect your profits and make sure you don't give back too much if the stock starts to turn south.
Makes sense.
He also offers some interesting insights on money management.
Okay.
He's not a fan of spreading yourself too thin.
Right.
advocating instead for concentrating your holdings in a handful of truly exceptional companies.
So instead of trying to own a little bit of everything,
Right.
it's better to focus on a few high-conviction bets.
Yes.
Kind of like building an all-star team of stocks.
That's a great way to put it. He recommends owning a maximum of 4 or 5 stocks at a time.
Wow, just 4 or 5.
This allows you to really dig deep into each company, understand its business model, and track its progress closely.
Right.
And here's another important point. O'Neill is vehemently against averaging down.
Averaging down.
That classic strategy of buying more of a stock as it falls in price to lower your average cost.
So no trying to catch a falling knife.
He calls it, and I quote, throwing good money after bad.
Ooh.
If a stock is going down, there's probably a good reason for it. Don't keep digging the hole deeper.
Got it.
Instead, learn from your mistakes, cut your losses, and move on to the next opportunity. One final piece of advice from O'Neill that I think is crucial for success is understanding the bigger picture, the overall market trends, and sector rotations.
So it's not just about picking winning stocks, it's about understanding which industries are in favor.
Yes.
And which ones are falling out of favor.
Exactly. Even the best companies can struggle if their industry group is out of favor.
Right.
O'Neill encourages investors to follow the leading industry groups, those that are showing strong relative strength and earnings growth.
It's like surfing.
Yes.
You want to catch the wave that's already building momentum, not the one that's about to crash on the shore.
That's a perfect analogy. And one of the things I love about this book is how it's packed with real-world examples. O'Neill constantly reinforces his points with historical data and charts showing how these principles played out in actual market conditions.
It's not just theory. It's a proven system based on decades of research and analysis. And the fact that this book was originally published decades ago,
Right.
yet the principles are still relevant today, speaks volumes about its enduring wisdom.
Absolutely. O'Neill really tapped into those timeless truths about the stock market and human psychology.
Yes.
And by understanding these truths, we can empower ourselves to become more successful investors regardless of our experience level.
This has been an incredibly insightful deep dive into how to make money in stocks. We've covered everything from the core principles of CAN-SLIM to the importance of charts, risk management, and market timing. It's clear that this book is a treasure trove of investment wisdom. For more such content, go to our channel, Pages and Perspectives. Don't forget to like, share, and subscribe, and press the bell icon to get the latest updates. Thank you for joining us.